Welcome to this deep dive. Our mission today is, well, it's pretty focused. We are synthesizing an investment thesis for a truly specialized and I think often overlooked infrastructure player. They operate deep within the Permian Basin, a company called WaterBridge, or WBI.
And we are not just analyzing another energy stock. That's really the key thing to get right up front. We're looking beyond, the volatile cycle of oil and gas production to understand how these essential defensive infrastructure assets anchored by some really deep geological and regulatory moats, are positioning themselves
Positioning themselves for what
to
exactly?
capitalize on the next wave of massive national demand.
Yeah.
Hyperscale digital infrastructure.
Okay, let's unpack this. This sounds like a really unusual merger of industrial waste and high-tech ambition. Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into WaterBridge, WBI. WaterBridge is a critical, high-margin, utility-like infrastructure provider, betting that its 51% EBITDA margin and 11-year acreage dedication contracts will justify a multiple expansion by successfully executing the massive PowerBridge digital infrastructure pivot against the high-stakes execution risk of fiber connectivity gaps and the 190,000 Permian worker shortfall.
That thesis statement, it perfectly encapsulates both the opportunity and the conflict here. You have a business that makes its money managing what is arguably the most challenging industrial byproduct in the country, this toxic produced water, yet it's structurally strong enough to even attempt to anchor an entirely new digital ecosystem.
It's a massive geographic pivot, and the success of the investment, it seems, hinges entirely on WBI successfully transitioning from one valuation bucket to another.
Exactly. From a commodity-related bucket to a true infrastructure utility valuation bucket.
That transition is the million-dollar, or I guess maybe multi-billion-dollar prize. But to understand the prize, we first have to appreciate the foundation. Let's start with that core business, the moat and the financial stability that they get from solving this enormous non-negotiable problem in the Permian.
Right, and it starts with produced water as industrial waste. The scale of this issue, particularly if you look at the Delaware Basin, is just staggering. The whole focus of the Permian is, of course, oil, but the dominant volume challenge is the water that comes up with it.
And that ratio just keeps climbing, right? Based on the recent data, for every single barrel of marketable oil they extract, the industry is generating approximately, 4 barrels of problematic produced water?
It's getting closer to that 4.1 ratio every day.
Yeah.
And you can think about it this way. You might pull up an Olympic swimming pool of oil, but you are simultaneously creating 4 Olympic swimming pools of toxic brine that you have to deal with immediately, safely.
And that word problematic is really doing a lot of work there. This isn't just, slightly dirty drilling fluid.
No, not at all. This water is residual from ancient seas. It's many magnitudes more selenic than regular ocean seawater. We are talking about concentrations of total dissolved solids, TDS, that can reach like 150,000 milligrams per liter. It's incredibly corrosive. It's full of heavy metals, trace hydrocarbons, compounds that make it completely impossible to discharge without catastrophic environmental harm.
So, okay, this is not a desirable byproduct. It is a critical waste stream that literally dictates the pace of production. If you can't get rid of the water, you simply can't produce the oil.
Exactly. And that is why WBI's service is an absolutely essential service for oil and gas production. When an E&P company, an exploration and production company, is drilling, they need guaranteed, immediate, high-volume capacity to move that water off their site.
And if they don't have it, what happens?
If for any reason, a pipeline rupture, a regulatory capacity restriction, maybe a mechanical failure at a disposal well, if they cannot legally and safely dispose of this water, they must stop producing. They are required to get shut in, curtailed. The water logistics become the absolute choke point for their entire billion-dollar operation.
That necessity then gives WBI this immense, almost utility-like leverage over some of the world's biggest energy companies. And you can see that necessity reflected directly in their financial profile. They seem largely insulated from the wild cyclical swings of oil prices.
They are, because producers have to pay WBI whether oil is $50 a barrel or $90 a barrel. Their revenue stream is based on volume handled, not the commodity price. Their whole business is collecting that water, using their massive pipeline network to move it, and then either disposing of it safely deep underground or treating it for reuse in other fracking ops.
Okay, let's delve into those core financial metrics, because this is where that utility comparison really starts to shine. For handling that massive volume, the core business revenue runs around 78 cents per barrel handled, which, Doesn't sound like a lot.
Right, but when you're moving millions and millions of barrels a day, it adds up incredibly quickly.
And the margin generated from that fee is what's really
Okay.
exceptional.
It is. The adjusted operating margin is about 44 cents per barrel of water handled. So if you just do the math on that, it translates to roughly a 56% operating margin on their core business. You typically only see that level of efficiency in like highly regulated essential monopolies.
But hang on, the number in the thesis statement was a 51% consolidated EBITDA margin? That is practically unheard of in an infrastructure business that isn't a regulated electric utility. What's driving that efficiency? Is it just scale, or is there some kind of proprietary tech at play?
It's a combination of scale, network density, and just massive operating leverage. See, unlike building a single disposal well that might serve one or two pads, WBI built a huge centralized interconnected network. We're talking 2,500 miles of pipeline.
Okay.
So once that pipeline is in the ground, the marginal cost of adding a new barrel of throughput from a nearby well is extremely low. They have high fixed costs up front, for sure, but the variable costs are minimal. And that allows that massive operating leverage to translate directly into that staggering 51% consolidated EBITDA margin.
And that margin, that efficiency, is then protected by their contract structure. This gives investors a really remarkable degree of visibility, right? We're not talking about like 6-month service contracts.
No. The weighted average contract life for WaterBridge is around 11 years. That gives you visibility into the revenue and volume streams well into the next decade.
And these contracts are also structurally defensive, I take it.
Critically so. They're designed to protect that 51% margin against, the inevitable cost increases that hit any big industrial operation, labor, materials, you name it. They use CPI-linked escalators, which just means the fee per barrel automatically adjusts upwards with inflation. It minimizes any margin compression over the life of the deal.
And the best type, the most protected contract type, is something called Acreage Dedication. This isn't just a promise to use WBI for a certain volume. It's more of a commitment.
It's binding, yeah.
Yeah.
Acreage dedication guarantees WaterBridge all the water flow generated from a specific huge block of land, could be tens of thousands of acres, that's operated by that E&P company. It basically eliminates the producer's option of building their own disposal wells or switching to a competitor in that zone. For WBI, it locks in predictable, decades-long volume. It's the closest thing to a guaranteed annuity you can get in the energy space.
Okay, so we've established WBI is a rock-solid, high-margin utility with guaranteed revenue streams. Let's move to that second major structural advantage, the regulatory and infrastructure moat. These are advantages they didn't really build themselves, but more, inherited and capitalized on because of shifting regulations.
This is a classic case of regulation creating immense value for the incumbents. The story starts with geology and, really, the unintended consequences of the early disposal practices after the shale boom took off.
Right. Historically, companies would just inject the produced water deep underground into porous rock formations. Seemed fine. But as the volumes just exploded, I mean, we keep coming back to that 4 barrels of water for every barrel of oil, these deep injections started interfering with geological fault lines. And that eventually led to noticeable seismic events or earthquakes, especially in places like Oklahoma and West Texas.
And that, of course, got the attention of the Texas Railroad Commission, the state regulator. They imposed much stricter regulations on disposal permits. They limited the zones and the pressures operators could use. And the critical consequence of that, especially in the Delaware Basin, is that operators they've run out of, quote, pore space.
Let's define that real quick for the listener. When we say pore space, what are we talking about?
We're talking about specific, deep geological formations, usually, saline aquifers or depleted oil reservoirs that are porous enough to safely accept these massive volumes of water without creating undue pressure that could trigger one of those seismic events.
And because of those regulations, that space is now scarce. It's finite. So that regulatory-induced scarcity, that's WBI's first big competitive moat.
Exactly. Their existing permitted capacity, which they spent years and a fortune securing and building out, is now incredibly valuable, and it's extremely difficult for any competitor to replicate today.
We saw some clear evidence of this, didn't we? When major players started using their capital to preemptively lock in capacity. The sources show that Devon Energy, for instance, actually paid WaterBridge just to reserve future disposal capacity, 3 to 4 years in advance.
Right. They're willing to pay today just to ensure that the infrastructure will be there when their own multi-billion-dollar drilling program needs it. It just demonstrates that capacity access has become a strategic bottleneck for the entire industry.
Mm.
If you're an E&P company, the single biggest threat to your production timeline is not being able to dispose of your water. WBI offers insurance against that threat.
Okay, now this is where it gets really interesting from a legal perspective and what really cements their dominance. The second moat is effectively a legal oligopoly, and it comes from these specific nuances in Texas property law.
Yeah, if we connect this back to the bigger picture of energy development, mineral rights, so the ability to extract oil and gas, have what amounts to an effective right of eminent domain in Texas. Basically, a surface landowner can't typically prevent an E&P company from drilling or laying an oil or gas pipeline across their land as long as fair compensation is paid. It's designed to support the build-out of the energy grid.
And this is the key vulnerability for anyone trying to compete with WBI in water or logistics. Water is not protected by eminent domain in Texas.
And that creates an almost insurmountable barrier to entry for any new player trying to build a rival network. If a potential competitor wanted to build a new 50-mile integrated water pipeline network, which you'd need to compete at WBI's scale, they'd have to negotiate dozens, maybe hundreds of individual easements with every single surface landholder.
And any single one of those landholders can legally just say no or demand an exorbitant fee for that water pipeline easement. They couldn't do that for a natural gas line. It's like trying to build a 50-mile road where every 100 yards a different owner can hold up the entire project indefinitely.
It's a perfect analogy. And that legal reality just strongly favors incumbents like WBI. Their vast network of 2,500 miles of pipeline was built and permitted years ago, before this whole regulatory landscape really crystallized. They already cleared those legal and financial hurdles. The cost and the complexity of trying to replicate that network today is, for all practical purposes, economically infeasible. It just reinforces their market leadership.
So we've established WBI as this highly profitable utility-like operation with powerful regulatory and legal moats. But, stability alone doesn't justify a high-growth multiple. We need to talk about the sustainable volume growth drivers, the factors that ensure WBI's volumes keep growing, even if the broader Permian industry faces headwinds.
This is a critical point because it really addresses the cyclical risk that's inherent in any energy investment. The first driver is what we call the non-cyclical growth driver, the counteracting treadmill dynamic. Everyone in energy knows the oil production treadmill shale wells decline incredibly fast, so E&P companies have to constantly drill just to keep their oil production volumes flat. That's the stress point for the producer.
But WBI benefits from the complete opposite dynamic. As an oil well gets older, the water cut, that's the ratio of water to oil coming out of the well, it increases.
Significantly.
Right. The oil volume declines steeply, forcing the E&P company onto that treadmill. But the associated water volume coming out of the ground, it largely stabilizes and often continues for decades.
The contrast there is dramatic.
It is. While the E&P company is panicking about a 50% year-over-year decline in their oil volume and stressing about drilling new wells, WBI is just happily watching their contracted resource stream stabilize into this predictable, decades-long stable volume of water. They benefit from the maturity of the wells, not just the initial volatile production. That's fascinating. WBI is essentially hedging the decline curve risk of the entire Permian. But the volume isn't just stable, it's projected to grow robustly because of how drilling practices are evolving. Which brings us to the second major driver, the macro growth driver from lower tier drilling.
Exactly. As operators move out of the absolute prime, the sweet spot acreage, the geological layers that were easiest and cheapest to get to, they are increasingly moving into lower-tier drilling formations. Think deeper sections of the Wolfcamp geological layer. These are deeper, they're tighter, and it's just harder to get the oil out.
And the reason extraction is more expensive isn't just because it's deeper. It's primarily because there's substantially more water in those lower-tier formations. The geology itself is different.
The geology changes, the pressure regimes change, and the water-to-oil ratio just skyrockets. That 4.1 water-to-oil ratio we mentioned, that's really the average across the basin today. But as the industry shifts into those deeper water-rich zones, that ratio is projected to increase substantially. It's going to move to 5.1, 6.1, or even hit 10.1 in certain deep formations over time.
So WBI gets a boost from two sides. The existing wells are getting older, which means a rising water cut, and the new wells are being drilled into formations that are just inherently wetter to begin with.
Exactly. So if you synthesize those two forces, the organic growth projection is really compelling. Even if Permian oil production were to, say, plateau or stay flat for the next 20 years, which would mean E&P companies are just successfully staying on that, treadmill water volumes are still projected to grow significantly because of these structural geological changes in the aging wells.
And that leads to an estimated, what, a 15% or better organic growth rate for WBI over the next 3 to 5 years.
That's the projection. And that's purely based on existing industry dynamics,
Mm.
the rising water cut and the shift to lower-tier drilling before we even touch the high-stakes digital pivot.
That 15% guaranteed contracted growth plus the 51% EBITDA margin and the 11-year contracts. That's why this valuation arbitrage case is even possible. WBI is already performing like a high-end utility.
Now we get to swing for the fences.
Exactly. Now we talk about that potential arbitrage. This brings us to the strategic optionality, the data center catalyst. This is the pivot that could completely redefine WaterBridge from a waste utility into a foundational digital infrastructure provider.
And this transformation, it hinges entirely on exploiting the Permian's unique energy abundance. Because of massive pipeline bottlenecks that prevent the gas from reaching large markets, the region offers the nation's cheapest, most stranded power.
The economics are just. They're astonishing. The Waha Natural Gas Hub has seen gas trade at negative prices for 46% of 2024.
Think about that. You're paying someone to take your fuel source away. This stranded resource, this negative cost energy, becomes the ultimate lure for these massive, power-hungry digital infrastructures, like AI data centers.
And this is where the alignment through their financial sponsor, 5 Point Infrastructure, becomes so crucial. WBI's aligned land partner, a company called WaterBridge, entered a key agreement with WaterBridge LLC.
WaterBridge is the vehicle for this whole pivot. It was formed in May 2025 with a huge $1 billion in equity commitments from 5 Point. But what's even more crucial is the leadership. WaterBridge is led by CEO Alex Hernandez, who has proven directly relevant experience.
Yeah.
He built a 1-gigawatt data center campus connected directly to a power source before.
And the analogy there is what? He connected data loads to a nuclear plant, right?
Right. The definition of stable, non-cyclical, baseload cheap power. And stranded Permian gas, if you capture and use it on-site, presents an equally stable and far, far cheaper, though geographically challenging, baseload solution. They're trying to basically translate that proven model to the Permian.
And WBI is providing the crucial logistics and the land assets that make this build-out even possible. They own over 20,000 acres in Reeves County, which is strategically located right where the stranded gas is most abundant, and, critically, it's near multiple existing fiber providers, even if they are insufficient for now.
WBI's network and land are essential because this data center pivot requires a one-stop shop solution. Data center developers, they don't want to acquire land, then negotiate power agreements with producers, and then separately try to figure out water logistics. WBI controls the raw material aggregation, the water, and the necessary land footprint.
Okay, but this introduces what seems like the most difficult, expensive, and technical challenge of the whole thing, the water quality crisis. Data centers need huge volumes of water for cooling, sometimes millions of gallons a day, but the raw material WBI handles is toxic brine.
The incompatibility is it's dramatic. Like we said earlier, raw produced water quality averages 130,000 millel TDS. To put that in perspective for you, the Dead Sea is roughly 340,000 millel. WBI's water is about 40% as salty as the Dead Sea.
Wow. And what's the tolerance for a mission-critical facility like a data center cooling tower?
A data center cooling tower typically has a maximum tolerance of 5,000 ppm parts per million, same as MGL. So we're looking at a 26-fold difference in salinity. Anything higher than that rapidly corrodes the equipment, it causes scaling, and it dramatically increases maintenance downtime, which is a killer for these facilities.
So you can't just pipe the brine into the cooling towers. This means you need complex, incredibly expensive advanced treatment. What are the solutions on the table, and how does WBI's network actually help?
Well, since traditional reverse osmosis is often just too expensive for this level of salinity, the conversation centers on advanced techniques like fractional freezing. It's a technology that uses low temperatures to precipitate out the solids. You essentially freeze the fresh water and leave the salt behind. Texas Pacific Land Trust has even filed patents on this kind of tech. But the capital expenditure for these advanced plants is massive.
But here's the genius of WBI's position. Even if the purification itself is expensive, WBI's network, with its guaranteed millions of barrels of throughput every day, is the essential logistics platform for the raw material feedstock.
That's it exactly. You can't build a massive purification plant if you can't guarantee the input supply. WBI can reliably deliver the necessary toxic brine at scale to centralized treatment facilities built right on their dedicated acreage. They solve the logistics problem, even if the processing requires that major capital investment PowerBridge is prepared to make.
All right, let's pivot now to the final verdict. Let's synthesize the financial reward against what seems like significant execution risk. The whole investment case hinges on achieving a higher valuation arbitrage.
Absolutely. WBI's current valuation today is anchored in the traditional energy space. It's typically benchmarked against 9x G&P peers, that's gathering and processing companies. These are pipeline operators, midstream assets that are viewed as being, somewhat cyclical and exposed to Permian drilling volatility.
But the core argument, and where the potential massive return comes from, is that WBI is structurally superior to a traditional G&P company.
Right. Because of its 51% EBITDA margin, its 11-year contracted life, and its essential regulatory moats, the appropriate valuation target is really 14 by 18x infra waste peers. We're talking about companies like Waste Management or Casella. These companies operate in similar oligopolistic, high-margin essential service markets that have regulatory protections and are insulated from economic cycles.
That is almost a doubling of the multiple. If they achieve that, the investment is a home run. But that success, as the thesis statement laid out right at the top, is entirely conditional on successfully executing this pivot. And they're on the clock. The PowerBridge option agreement requires site development within 2 years.
The risk is enormous. And it really boils down to overcoming 3 major infrastructure gaps that prove the Permian is just.
Yeah.
It's not ready for AI-level digital demand.
Ah.
Not yet.
Okay, the first risk is critical to AI and machine learning workloads. The fiber connectivity gaps. AI and LLM workloads demand just astronomical bandwidth. They need continuous, low-latency, 800 Gbps fiber connectivity per link.
And the existing regional standard that services the Permian today is closer to 100 Gbps. It's totally inadequate for hyperscale AI operations. This means the developer, PowerBridge, is facing the monumental capital expenditure and permitting challenge of building a dedicated high-capacity fiber backbone over 330 miles back to a major peering point like Dallas or Phoenix. And this isn't just digging a trench, it's securing right-of-way, ensuring redundancy across hundreds of miles of remote, harsh terrain.
The second gap is one of life safety and insurance requirements, emergency service gaps. These data center facilities are mission-critical, multi-billion-dollar assets. They require immediate attention if there's a fire or an incident.
But these remote locations currently have 30-45-minute EMS response times for fire or ambulance. That is completely unacceptable for high-value assets. And maybe more importantly, it's unacceptable to the insurance underwriters who are financing these projects. So developers are forced to fund significant private safety infrastructure, massive dedicated water storage for fire suppression, agreements for rapid first responder teams. It's a huge non-core operational cost that eats into those stranded gas savings.
And the third major hurdle is the human one, the workforce constraint. The sources project that the Permian region is going to face a massive shortfall of 190,000 skilled workers by 2040. That's driven by high costs of living and just how remote the location is.
Right. And while the existing oil and gas workforce offers some transferable mechanical and electrical skills, these new digital facilities require a completely different caliber of talent. You need highly specialized IT technicians, network engineers, complex facility maintenance staff who live and breathe 247 uptime protocols. These people historically do not flock to remote West Texas, where housing is scarce and family amenities are few.
So even if they build the perfect, cheapest power data center on the planet, if they can't reliably staff it with these highly specialized, certified technicians, the whole operation fails. The cost of recruiting, housing, and just retaining this talent could completely erode the massive cost advantage they get from the stranded gas. It's a human capital logistical nightmare.
Precisely. The synthesis is that WBI is the defensive anchor in this play. They offer predictable, high-margin growth because of the non-cyclical nature of produced water and their strong moats. They are already a great infrastructure asset.
But that transformational upside, that jump from a 9x energy multiple to an 18x waste utility multiple that requires successfully navigating these severe execution hurdles in fiber, in safety, and in human capital. It relies entirely on the PowerBridge JV team's ability to build a highly complex, interconnected digital ecosystem from scratch in the middle of a remote industrial environment that was never, ever built for the digital age.
It really boils down to whether the massive cost savings from that negative-priced stranded gas can justify the immense private investment needed to fill the fiber, safety, and human capital voids in West Texas. It's the ultimate build it and they will come strategy. But the They, in this case, are highly specialized engineers and technicians.
I think the complexity of this deal is what makes it so fascinating to track. The human infrastructure, can they actually staff these 247 mission-critical facilities with highly specialized technicians and maintain the uptime required for LLM workloads? That might ultimately be the billion-dollar question that determines the success of this whole geographic pivot 5 years from now. It might even eclipse the cost of the fiber and the water treatment combined.
Risk defined. Portfolio protected.